All right, so we're doing a class, real quick class. All right, we're doing a real quick class. Dave, one of the guys in the room had asked me if this is a triangle right here, and in face value, it looks like a triangle. Obviously, right? It looks like a triangle. It looks like you have your point, you have the two ends. It does look like a triangle, but um, when you're looking at a triangle, there's a structure that has to be included with it. So if we were to take, let's just take market goes down, and what we're going to do is we're going to draw it in pink. So we'll do something like that. Okay, one, okay, you got this, you got this, okay, then you got this. Okay, so when you look at a triangle, you want to make sure you have multiple data points. You want to have at least 2 data points on each side. Okay, you want to have at least 2 data points. Let me just stretch this out a little bit. Okay, for instance, something like that. Okay. And let's just change the colors. Okay, we'll change the colors. So let's take this particular part right here. This is your starting part right there of where the swing that created the like for instance, this could have done this. Okay, that the market could have done something like that. All right, and then we take the end point of where the trend line touches across the data points. Right, so across these data points, that's where your trend line hits. All right, and what I like to do is I like to take the Fibonacci time zone, and I'll take it from 0 to the end where it's 100%, right where it's 100%. So if you look at it, you have 0, 100, and then I take 75, right there. I take 75. I'm not sure I can make these things bigger or thicker. I'm not sure. Let me just see. No, you can't make the numbers bigger. So in here is 75%. So when you're looking at uh, right here, when you're looking at a triangle, right here becomes the most important component of it, the breakout zone. You're always looking at price and time. So David Marcy, we're always looking at price and time. You follow me? Price and time. So you're looking at this market, okay? You're looking at the market. For instance, this could be any market. It could be stocks, could be forex, could be futures. It doesn't matter. And you know that it's created these data points. So you got to look at them and let's count. Let's count the first one. This is data point 1. That's 1, 2, right? You got 3, you got 4, and then you got 5. Okay. Now, in some circles, guys that like to do this type of work, they're going to tell you it needs 4 data points. Essentially, all right, if you're looking at this, you have the 4 data points that typically are needed or required. So these data points are really the most important. And then you're looking at the zone where the market, where time has to come in play, okay? Remember, there's always price and there's always time, all right? So when you're looking at the triangle, symmetrical triangle, you're looking for a breakout point, and you're looking at that point right there and this point, okay? You're looking at these 2 points right there, these 2. So you have 1, 2, 3, 4, 5, and then it's going to chop, and then you're looking for a breakout. You're looking at these past 2 swings here. If that's wide, you then take the smaller swing, okay? You could then take the smaller swing and do that. All right, so you're looking at that, something to that effect. This can have at least 5 data points, even more. Doesn't matter. You're looking at 75% of the triangle before you would have an anticipated breakout up or down. Up. Okay, blue's up. Turquoise, blue. Blue is up. And red is down, okay? Okay, so you're looking at 75%. That's when the pattern matures. You have the multiple trend, you have the multiple data points, 1, 2, 3, 4, 5, and right here, 75% into it, that's where you have where the pattern matures, and you're anticipating a breakout. Now, what you want to also do is you take the middle of this channel, the middle of the triangle. You see that? Guys, you all watching me, or you're greeting each other? All right? So pay attention. Right here, the middle of the pattern. Okay, the middle of the pattern. So when this market, if it's to trigger up, say it goes here. Okay, your stop, David Marcy, your stop is right here at the middle. Okay? Okay, it's right in the middle at the apex. All right, you follow me? There's rules to this shit, man. Like Biggie said, there's rules to this shit. All right? Most people don't understand this. They don't get it. Okay? This is levels, man. So you understand, when you look at the market, you have to put the structure there. And you have to be methodical. So if in fact it does hit this particular price point, all right, you then are buying and your stop is in the middle. The price should not come back to the middle whatsoever. If it does, then what you have, right? If it does, right? Sometimes it'll do that, and this will happen. You'll get a failed breakout to the other side. Okay, if in fact that happens, you then want to become doubly aggressive down here. So if the first price fails, when it comes down here, you want to be doubly aggressive. You follow? Doubly aggressive, because what they call is a fake out breakout. Okay? All right, that was something my mentor had coined a long time ago. So if it goes to break out and it fakes out, it most likely will come out the other side more aggressively. However, if in fact it does break out to the upside, the first pullback is always also the best to enter into a trade. So for instance, let's just say it broke out and you spotted it. You wait for that first pullback, Okay, well, you know what? Breakouts become very noisy if you're not waiting for the maturity. You got to wait for that pattern to hit around 75%. After 75%, it gets so tight. It's like one of those pressure cookers. So it gets so tight, and then it's boom. So yes, for any market. This is any market, okay? This is any market. So what you're doing is, if in fact you don't want to buy the breakout, you let it break out, and that first pullback is your buy, and your stop is, of course, right at the middle of the triangle. All right? So, okay? So the longer the line, the longer the flight, okay? So, longer the line, the longer the flight. Now, a lot of people try to look at measured moves off of a triangle. But when you're coming out of a sideways line, a consolidation, when they break out, your job is not to sit there and go, well, let me get out. Okay? Because you guys saw last week we did trades where they were breaking out and we were buying them or selling them. You don't want to get in front of that. When they go, let it go. Let it run. All right? So your job is to monitor the data points. Once it breaks out, you have the choice to buy it with the stop in the middle. If in fact it breaks out and you miss it, you just look to buy the first pullback with the stop right down here also. And then look for that 5 wave to come in that we always talk about. You know, the Elliott 5 wave, guys, we always talk about that. A lot of times you won't get it this pretty. Okay? A lot of times it won't happen this pretty. What will happen a lot of the times, guys, is you get a breakout and it'll run. There's no looking back, okay? So a lot of times they'll just run, and what you're going to get, and make sure you take a note of this, shallow retracement, right? Shallow retracement. Okay, what this ends up becoming, okay, let's just draw this out here so we're all on the same page. This is triangle breakout. Triangle breakout. We did trades, guys that are coming on new right now. We did trades this morning in London. We gave 3 big trades, about 200 pips worth of work so far. They're ready. They're still moving. We gave a short sale on the EURUSD for the live room here. A little scalp, nothing crazy. Just, you know, a little food, a little taste. All right. All the bigger work is in already. Oops. 1, 2, okay, 3. Okay, so you know what typically will happen is you get these 3 drives to end the swing. All right, 3 drives will typically end the swing. So triangle breakout, if it breaks out and is very impulsive, like strong, you're going to get that drive, that shallow pullback, that drive, that shallow pullback, that drive. A lot of times when you get that second push up, traders tend to look at this and say, sell divergence. You know, oh, there's a sell, you know, because you got lower highs on their oscillator. A shallow pullback and then runs up and runs them over and then pulls back. So, you know, the structure, the structure when you're looking at triangles, this is what can happen. So a question about this became this whole monstrosity of a class, but the class right here is teaching you the conditions. The conditions. Here, these are 3 drives up, but this is not coming out of impulse. I'm talking real sharp impulse up. You tend to get that. All right? See, look right here, guys. See this right here? That right there and this right here, that's what's called a divergence. You had higher high in price, lower high in the oscillator. Okay? However, when you're breaking out from a triangle and you have a real breakout, you don't want to get out until you start getting these 3 drives. Once you start getting that 3rd impulse up, then you start exiting. Now, that's also a disclaimer. That first big move out, you're taking money off the table. But to clean up your trade at the end, that's where you have your 3rd drive. And then you're looking at the big corrective wave. And then you're looking at the market a little bit differently. And this is, look, I've been looking at the markets long enough. This is what it does all the time. All right. Then you have this. Up, down, and that's where you create that first bigger retracement. So your first move out. So you got it, guys? You got it? We're all on the same page? We're all on the same page? I thought we'd do a class, maybe 15 minutes. Okay, always the wicks. Always the wicks. Whenever you do charts, always the wicks. Do not do this. Do not do it through the body. Do not do that. It's always the ends, the highs and lows. Just like here, guys. Look, the wick. Okay, you see the wick? Always the wicks. All right. So let me save this.